Welcome to Newmont's third quarter 2024 earnings call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. Please note this event is being recorded. I would now like to turn the conference over to Tom Palmer, President and Chief Executive Officer. Please go ahead.
Thank you, Operator. Good morning, everyone, and thank you for joining our call. Today, I'm joined by my executive leadership team, including Natascha Viljoen and Karen Overman, and we'll all be available to answer your questions at the end of the call. Please note our cautionary statement and refer to our SEC filings, which can be found on our website. Before we discuss our third quarter performance, I would like to take a moment to remember Antoine Fortin, who tragically lost his life at our Illinois operation late last month. We recognise that this is our fifth fatality in less than a year, and we are working diligently to strengthen and improve our safety systems, along with the key safety tools that we use in the field. We are fully committed to understanding the factors that contributed to this tragedy and are taking decisive action to improve our safety culture, with a clear focus on effectively controlling all of the risks that could lead to a fatality. We will also continue to transparently share the lessons we learn from the investigation with our peers in the industry to help improve the safety performance of our sector. At Newmont, we know that a strong safety culture is fundamental to sustainably delivering on our commitments, and it is our accountability to ensure that everyone working at Newmont returns home safely after each and every shift. Turning now to a summary of our third quarter. I'm honoured to have recently been appointed as the next chair of the International Council on Mining and Metals, or ICMM, and look forward to playing an even greater role in advancing sustainability and responsible mining practices, both at Newmont and across our industry. During my term as chair, one of my key priorities will be building support for the Consolidated Mining Standard Initiative, an effort we have strongly supported and actively engaged in over the last few months. These consolidated standards will be essential for strengthening the industry's reputation and providing stakeholders with confidence that the commodities we produce are mined responsibly. Last week, we announced that we have partnered with MKS PAMP to launch our first mine-to-market traceable gold bar for sale in the United States, making Newmont's gold directly accessible to consumers and demonstrating our commitment to transparent sourcing. Shifting to our world-class portfolio of Tier 1 and emerging Tier 1 operations and districts. In the third quarter, we produced nearly 1.7 million ounces of gold and 430,000 gold equivalent ounces from copper, silver, lead and zinc. And notably, this included 37,000 tonnes of copper. We generated $1.6 billion of cash flow from operations and $760 million in free cash flow. Our non-core divestment program has advanced meaningfully since our last earnings call, with the two recently announced transactions expected to deliver up to $1.5 billion in combined gross proceeds. The first announcement was a definitive agreement to divest the Telfer mine and our 70% interest in the Havieron project in Western Australia for total proceeds of up to $475 million. We continue to progress the closing conditions and expect to complete the transaction this quarter. The second announcement was a definitive agreement to sell the Akyem mine in Ghana for up to $1 billion in cash consideration, and we also expect to close this transaction towards the end of the year. With this solid progress, we remain firmly on track to realise our commitment to generate at least $2 billion in gross proceeds from the divestment of our non-core assets. It is also important to note that this is in addition to the $527 million in cash proceeds that we have already received this year from the Lundin Gold and Batu Hijau transactions. Our divestment progress and strong free cash flow generation have positioned us to be able to continue reducing debt and returning capital to shareholders. Since our last earnings call, we have retired $233 million in debt and returned $786 million to our shareholders through share repurchases and quarterly dividends. We also approved an additional $2 billion share repurchase program, bringing our total authorisation to $3 billion. In addition, we continue to safely advance the 3 projects we have in execution: the second expansion at Tanami, our new mine at Ahafo North, and the Panel Ks at Cadia. And finally, turning to synergies. When we announced our decision to acquire Newcrest, we committed to delivering $500 million in synergies from 3 areas: G&A, supply chain, and our Full Potential program. And as of today, we have achieved that $500 million synergy run rate. Starting with G&A, a $100 million synergy run rate was achieved through labour rationalisation and reductions in both insurance costs and contractor spend. Moving to supply chain, our team has been leveraging the scale of our combined company to achieve improved commercial outcomes that have already brought our synergy run rate from this area to $200 million. And finally, we have begun to realise significant value from our Full Potential program and are in the delivery stage of our initiatives at Cadia, Red Chris, and Lihir. From this work, we have successfully surpassed a $200 million synergy run rate, with potential upside to be realised in future years. The majority of the value realised so far has been attributed to Cadia due to the work we've been doing to more efficiently move stockpile material and to optimise the output from our high-pressure grinding roll system in the mill, an initiative that I touched on last quarter. And the remaining value has come from Red Chris and Lihir. At Red Chris, we're improving gold and copper recoveries from the optimisation of both the grinding and flotation circuits, while also increasing throughput by delivering a more consistent ore feed to the mill. And at Lihir, we are focused on improving efficiency by debottlenecking the materials handling and crushing circuits, as we mentioned on our first quarter earnings call. With our synergy commitment now met and our divestment program well advanced, we are now focused on the sustainable value that we will deliver from our go-forward portfolio of 11 managed, large, long-life operations. So with that, I'll now turn it over to Natascha for an operational update, and then to Karen to take us through our financial performance for the quarter. Over to you, Natascha.
Thank you, Tom. As we enter the final quarter of 2024, I'd like to start by re-emphasising the operational priorities I highlighted at the beginning of the year. Our focus remains on 3 key objectives. First is making sure that every person walking through a Newmont gate is fully equipped and authorised to do their work safely. Second is continuing to deliver strong performance from our managed assets, whilst also guiding our non-core assets through a respectful and productive process for divestment. And last is enhancing long-term productivity at every one of our 11 managed Tier 1 and emerging Tier 1 operations. Turning to the next slide, and let's begin with an operational overview. In the third quarter, our managed portfolio delivered a meaningful step-up in production as planned, producing 4% more gold than the second quarter, and building momentum for a strong finish to the year with an anticipated 1.8 million ounces of gold in the fourth quarter, or an approximately 8% increase over the third quarter. This performance has been largely driven by our 6 managed Tier 1 operations, which I now will touch on in more detail, and I will start with Tanami. We began accessing higher grades from the Liberator ore body and remain on track to deliver the year's strongest grades in the fourth quarter. At Boddington, we continue stripping in the north and south pits as planned, which is expected to continue through 2025 and will bring forward strong gold and copper grades starting in 2026. Moving to Peñasquito, we delivered steady gold, silver, lead, and zinc production in the third quarter from the Chile Colorado pit and commenced mining ore in the higher gold grade Penasco pit well ahead of plan due to efficient stripping. This will result in an increase in gold production in the fourth quarter and into 2025. And importantly, we have signed a new collective bargaining agreement with the union at Peñasquito, which safeguards the rights of all workers and provides a solid foundation for operations at Peñasquito through 2026. Turning now to Cadia. As factored in our guidance, grades at Cadia are expected to continue declining in the fourth quarter as we transition to and ramp up Panel Cave 2-3. We are progressing integrated studies to align cave development with life of mine tailings capacity, setting up Cadia for the next 3 decades of ore feed. Our focus for tailings is maximizing capacity in the current in-pit storage facility, repairing the southern wall of the northern facility that slumped in 2018, and then raising the wall of the southern facility. These efforts are expected to contribute to a period of increased sustaining capital spend at Cadia over the next few years, as we make the necessary but disciplined investment to remedy and expand the current tailings facilities. At Lihir, we continue to progress the planned shutdown of the primary autoclave, which remains on track to deliver an approximate 30% step up in gold production in the fourth quarter of 2024 compared to the third quarter. As we look ahead to 2025, our operational focus at Lihir will remain on reducing complexity to deliver more sustainable and predictable results at this Tier 1 operation. In the short term, these efforts will result in lower than initially anticipated production next year due to lower throughput to allow for asset reliability improvement work and changes to the mine sequencing, including the establishment of wider ramps to manage surface water and repositioning all roads to be more effective and efficient. Whilst we complete this work, we will be processing a higher proportion of lower grade stockpiles in 2025, and we anticipate that gold production next year from Lihir will be largely consistent with this year's and around 250,000 ounces lower than our initial guidance for 2025 that we provided back in February. Importantly, this work will simplify and improve operations at Lihir for the long term, establishing it as a more consistent contributor as one of the 11 managed operations in our go-forward portfolio. Similarly, at Brucejack, we have taken a step back this year to do the development and drilling work to ensure that we improve our knowledge of this nuggety ore body. We continue to experience periods of exceptional high grades including a one-day average of 52 grams per ton last month and an average of over 20 grams per ton in the same week. As a result of the work we are doing, we anticipate that the gold production next year from Brucejack will also be largely consistent with this year, or around 100,000 ounces lower than our initial guidance for 2025 that we provided back in February. Moving to Ahafo South. In the third quarter, we achieved a significant increase in gold production of nearly 15% over the second quarter, driven by a higher mill throughput following the successful girth gear replacement in April and strong grades from our Subika open pit and underground mines. Looking ahead, we expect Ahafo South to maintain consistent production levels in the fourth quarter and into next year, before declining in the second half of 2025 when we complete mining activities at the Subika open pit as planned. And finally, during the fourth quarter, we expect to commence mining activities at Ahafo North and will stockpile ore to be used to commission the mill next year. This will be an essential milestone for our African business unit as Akyem is divested, and production is replaced with new, low-cost ounces from Ahafo North towards the end of 2025. Continuing with Ahafo North, we have made notable shift from land clearing and earthworks to constructing the infrastructure for this new mine. The carbon and leach tanks are complete, and we continue constructing the crushing, conveying, and mill infrastructure, which you can see in the photo in our presentation. We recently completed the lining of the tailings storage facility and are establishing the haul roads to begin stripping at this new mine in the fourth quarter. At the second expansion at Tanami, our focus remains on the concrete lining of the shaft, and we have completed more than a kilometer of this 1.5 kilometer deep production shaft. As you can see in the photo, the winder building is now largely complete, and we are preparing to install the hoisting machinery, which will be used to raise and lower our people, equipment, and ore within the mine shaft once complete. Our Cadia Panel Caves project is progressing well. At Panel Cave 2-3, we have achieved cave establishment, meaning that the intended fracturing has begun and gravity is now playing an important role in the mining process. This is a significant milestone for this multi-year project, and we are successfully processing gold and copper ore from this cave. Over the next decade, Panel Cave 2-3 is expected to deliver 1 million ounces of gold and more than 400,000 tons of copper, and is anticipated to ramp up to an average of 400,000 gold equivalent ounces between 2027 and 2032. At Panel Cave 1-2, we continue to advance underground development and the construction of the materials handling system. As a much larger cave, Panel Cave 1-2 is expected to deliver nearly 4 million ounces of gold and more than 700,000 tons of copper over its 15-year cave life, and it is anticipated to ramp up to an average of 525,000 gold equivalent ounces between 2030 and 2040. And with that, I'll turn it over to Karen.
Thank you, Natascha. Turning to the next slide, I'll begin with an overview of our financial performance for the quarter. Building upon Tom and Natascha's remarks, Newmont delivered strong third quarter results. We reported adjusted EBITDA of $2 billion, driven by sustained gold prices and strong quarterly production. And we recorded adjusted net income of 81 cents per diluted share, an increase of 9 cents compared to the second quarter. We also generated $1.6 billion of cash flow from operations and $760 million of free cash flow, which does not include the approximately $300 million in cash payments received during the third quarter from the sale of the Lundin Gold financing facilities and Batu Hijau contingent payments announced earlier this year. Free cash flow for the quarter includes $209 million of unfavorable working capital changes, largely due to a build in stockpiles of $202 million, mainly at Lihir and Telfer, and $107 million of reclamation spend, primarily related to the construction of the Yanacocha water treatment facilities. With $273 million in reclamation spent to date, we anticipate an approximate $225 million to be spent next quarter. These unfavorable working capital changes were partially offset by the favorable timing of accrued liability payments. Looking ahead, we expect to reach the year's strongest production volumes in the fourth quarter, positioning us to deliver strong free cash flows and to continue returning capital to shareholders. As Tom mentioned, the divestitures announced to date from our non-core portfolio are expected to generate up to $1.5 billion in gross proceeds on top of the nearly $530 million in cash proceeds received from other investment sales in 2024. And as we committed to earlier this year, we have been using the proceeds to create long-term value for our shareholders by strengthening our balance sheet and repurchasing shares. Since our last earnings call, we repurchased 9.4 million shares at an average price of $53.16 per share for a total cost of $500 million, including $198 million repurchased during the third quarter and $302 million in October. And with $250 million remaining in the current program, Newmont's board authorized an additional $2 billion share repurchase program to be executed over the next 24 months, bringing our total authorization to $3 billion. To date, we've now completed $750 million of our $3 billion authorization. Additionally, we declared a fixed common third quarter dividend of 25 cents per share, consistent with the dividend declared for the past 3 quarters. And we purchased $233 million in nominal debt for $210 million, or around 90 cents on the dollar, of which $150 million was purchased during the third quarter and $83 million was purchased in October. To date, we've now retired nearly $500 million for the year. We maintained an investment-grade balance sheet and ended the quarter with $7.1 billion in total liquidity. And our gross debt now stands at $8.5 billion compared to our target of $8 billion. In line with our balanced capital allocation strategy, we continue to focus on maintaining a strong balance sheet, steadily funding value-accretive capital projects, and returning capital to shareholders. Looking ahead, we expect approximately 1.8 million ounces of gold production in the fourth quarter as planned. Production from our managed Tier 1 assets continues to drive our strong operational performance, and we remain on track to meet our full-year production guidance. As signaled by our joint venture partner, production from Nevada Gold Mines and Pueblo Viejo is expected to significantly increase in the fourth quarter, which is crucial as these sites comprise just over 20% of our attributable gold production for 2024. All-in sustaining costs for the fourth quarter are expected to be approximately $1,475 an ounce, which represents an 8% reduction compared to the third quarter. This favorable decline is expected to be driven by higher gold production volumes and will be slightly offset by higher sustaining capital reinvestment, primarily anticipated at Nevada Gold Mines based on the run rate through the third quarter, and Cadia to remedy and expand the current tailings facilities, as Natascha described. Increased production taxes and royalties from a higher gold price environment, and slightly higher G&A spend, largely due to an increase in contracted labor. Turning to development capital, we expect to spend $320 million during the fourth quarter, keeping us on track to meet our full-year guidance estimates for earlier this year. And we continue to expect to invest an average of $1.3 billion per year into projects that will generate the highest returns. With that, I'll pass it back to Tom for closing remarks.
Thanks, Karen. We remain confident in the long-term strength of the go-forward portfolio we have assembled and continue to make solid progress on the 4 key commitments we made at the start of the year to our shareholders. Since our last earnings call, we continue to diligently implement the lessons learned from our recent fatalities and are working to strengthen and improve our safety and risk management systems. We delivered higher production as planned, keeping us firmly on track to meet our full-year production guidance. We generated $1.6 billion of cash flow from operations and $760 million in free cash flow. We made meaningful progress on our portfolio rationalisation with the announced divestments of Telfer, Havieron and Akyem. We achieved our synergy run rate target of $500 million. We demonstrated our commitment to shareholder returns, delivering $786 million from both regular dividends and share repurchases. We strengthened our balance sheet with $233 million of debt reductions, and we approved an additional $2 billion share repurchase program, bringing our total authorisation to $3 billion. Having now gained almost a year of experience working with our new operations, we have developed a much deeper understanding of their long-term contribution to our core portfolio and the work needed to create consistent and lasting value for our shareholders. Looking ahead to 2025, we expect gold production from our go-forward Tier 1 portfolio to remain largely consistent with this year, driven by the lower than previously expected production from 2 of our new operations in Lihir and Brucejack. We expect unit costs from our core portfolio in 2025 to align with the trends we are observing this year. We also remain committed to the critical tailings work at Cadia, which may result in an annual sustaining capital spend of around $1.8 billion from our core portfolio over the next few years. And we continue to see higher than previously expected direct costs and G&A spend that, with the clarity of our go-forward portfolio, we are now working to manage. With this context, my leadership team and I have a laser focus on the work we need to do to optimise our go-forward portfolio of 11 managed operations and 3 projects in execution. Whilst we do anticipate production growth over time, our focus is firmly on expanding margins, generating a strong return on capital invested, and creating value versus chasing volume. We are taking a critical look at our organic project pipeline and spending time to ensure that any reinvestment we make into our portfolio is both disciplined and deliberate. And we're applying an economic lens to the long-term decisions we are making today, ensuring that we deliver on Newmont's purpose to create value and improve lives through sustainable, responsible mining for decades to come. With that, I'll thank you for your time today and turn it back over to the operator to open the line for questions.
Thank you. We will now begin the question and answer session. We ask that you please limit inquiries to 1 primary question and 1 follow-up question. And to ask a question today, you may press star, then 1 on your touchtone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then 2. At this time, we will pause to assemble our roster. And our first question comes from Daniel Major at UBS. Daniel, your line is open. Please go ahead.
Hi there. Can you hear me okay?
Be loud and clear. Thanks, Dan. Tom here.
Great, thanks. Yeah, sort of 2 parts to the question, but I mean, the first one is perhaps a kind of reflection on the industry as well, but when I look back to February and you look at your cost profile and medium term, like many in the gold industry, you've got costs coming down over time over the next few years. Yet this year, all-in sustaining cost $100 higher than you saw in February. Is it realistic and credible to actually assume that unit costs will moderate over time, or should we rather be assuming that the best case outcome is limiting inflation?
Yes, thanks, Dan. I'll kick that off, and Karen, you might want to jump in as well. Certainly, if I think about the gold industry, there's always been a strong correlation between gold price and the cost of producing an ounce of gold, given that inflation is one of those key structural elements behind the gold price. So as you look forward, if gold price eases, then you'd expect the cost of producing an ounce to ease, and obviously you see some tracking between the cost per ounce and the gold price. Our focus is on what we're putting in place is that we have 11 managed operations going forward, where we're going to be in a position to be looking over the long term and strengthening and growing those margins. The other comment I'd make before I pass to Karen, if you wanted to build on that, is when you look at the out-year numbers that we had provided back in February, that assumed zero escalation. And so when you think about any forward-looking numbers, there's no escalation. And obviously what we're seeing as we get closer to 2025, the run rates we're seeing as we close out this year are largely going to flow into next year as we understand the costs for the next 12 to 15 months. Karen, anything you'd build on that?
No, I think that's right, Tom. It's just to emphasize those out years, as you mentioned, don't have an escalation in those. Generally speaking, as we indicated, the costs that we're seeing here in 2024, we do expect those to trend into 2025. Costs were higher, driven by higher direct costs, primarily. If you think about contracted labor, which is 50% of our cost structure, we've seen those increase into the third quarter and through the year. And so we expect that that's been built in now into our cost estimates as we head into 2025.
Thanks, Karen. Dan, did you say you had a second part to your question?
Yeah, I had a second part, if that's okay. Just thinking about your guidance comments for 2025. You previously looked at in February around 6 million ounces from the core portfolio in terms of gold. You highlight in the comments 250,000 ounces lower than your previous plans at Lihir and 100 at Brucejack. So is it fair to then assume 350,000 off the 6 million is the new base when we look into 2025?
Yeah, thanks, Dan. Certainly, they're the two movers in terms of our managed portfolio. And as Natascha said in her remarks, and I followed up with the drivers behind that mine sequence at Lihir and getting in front of understanding the resource definition of Brucejack and the development work and the drilling you need to do for that. Both of those are progressing well, but it's the ounces for next year reflect that important work. I think the numbers, if you then look at the rest of the portfolio and those trends coming through from 24 flowing into 25, the number's more like 5.6 as you think about this portfolio for 2025, the core portfolio for 2025. Obviously, we've got some divestments to close out and still got some more work to do on that front. Some of that will flow into 2025 as we complete that divestment work, but that core portfolio, 5.6 is about their gold production number for next year.
Okay, thanks. So yeah, it's sort of broadly flat production and costs into next year is the message. Okay, thank you.
Thanks, Dan. That's correct.
The next question comes from Josh Wolfson from RBC Capital Markets. Josh, your line is open. Please go ahead.
Hi, thanks very much. I'm trying to wrap my head around the change, the significant change in sort of cost expectations and to some degree production expectations going forward, versus what we had been hearing about previously. And I guess there's sort of two different aspects, at least that I can understand. One is, despite the synergy targets being achieved, it sounds like there's some larger integration issues, given the challenges or higher costs mentioned across Brucejack, Lihir, and Cadia. And then on the other hand, we're hearing, significant and unexpected inflation expectation changes, which I guess would be a larger industry-related item. I just want to sort of clarify, how should we be thinking about these things, and am I sort of assessing this appropriately? Thank you.
Yeah, thanks, Josh. Let me kick off, and again, Karen, you might want to jump in. So maybe pick it up in a few parts. I think the commentary around Lihir, Cadia, Cerro Negro, I think you mentioned, is really the Q3 cost story. So it's around Lihir. We had some costs that we had assumed would be in the fourth quarter for the large autoclave shutdown, specialist labour in a remote part of the world moving into Q3. So that's one of the drivers there. Cadia was power, where a high power cost coming off our contract for price taker. Cerro Negro was more around the ramping up following the tragedy earlier this year, making sure we're focused on doing that work safely, some productivity impacts. And then the other factor in the third quarter was we had some concentrate sales out of Penasquito didn't get away at the end of the third quarter due to some weather impacts there. They obviously flow into the fourth quarter. So that's sort of a bit of a wrap up of the third quarter cost story. When I look at 24 flowing into 25, so there's two impacts. There's the volume impact we just talked about with Dan and the Lihir and Brucejack work next year linked to that. And then the cost impact is sustaining capital, and particularly around the work we're putting into the tailings facilities at Cadia. Cadia's got a 30-plus year life, several panel caves from come on, and there's work we need to do to ensure that tailings capacity is matched to the volumes coming out of those panel caves. So that story is around volume for those couple of key drivers, and then sustaining capital. Karen or Natasha, anything you build on the back of that?
Sure. Just to put a little more granularity in terms of 2024. So about a third of that is increased due to that lower sales volume, including impacts from Telfer, Lihir, and Brucejack. Another third relates to that higher sustaining capital that we've been talking about, largely driven by Nevada. And then the remaining third, half of that is about royalties due to higher gold price, and half associated with the G&A. So our run rate synergies are driven by the targeted benefits at Cadia, Red Chris, and Lihir. However, we've also had performance challenges within the business, including the Telfer tailings, as well as the non-managed that have underperformed expectations. And I think further to that, supply chain and G&A benefits have been impacted by our need to invest in the future of this combined Tier 1 portfolio, with a key focus in areas with the integration from New Crescent to Newmont as needed. But we're not happy with where we're at, and we're working to reduce these costs.
Thanks, Karen.
Thank you. And if I can add sort of the follow-up question, just sort of understanding if there's a quantum that can be provided in terms of maybe what the inflation trends is the company is seeing, something that we can think about for modeling forecasts on operating costs or capital costs. Is there sort of any, initial impressions you have on what inflation rates are running at currently?
Yeah. Yeah, Josh, we're seeing in terms of input costs around consumables, fuel, materials,